I think we're in the bottoming phase. Like maybe the local bottom is in. But could we pull back? Of course we could pull back.
Yeah.
But look, I have every confidence that we're going higher, over the next 12 months. The dominant paradigm here is AI as a deflationary force, and the administration wants lower rates, and I think it will get lower rates. Maybe that changes if oil spikes to 150, but that's not the base case that most people are operating in right now. So yeah, not next month, but over time, we're going to get lower rates this year. It's going to be positive for risk assets. One of my favorite tells of whether we're in a bear market or a bull market is how we react to good news. In a bear market, we ignore good news, right? Yeah. When Apollo bought Morpho's token, it went up and came right back down. When BlackRock bought Uni's token, came up, went right back down.
Yeah.
Today, when we have good news, like Trump posting something positive on crypto, we just rip. So we're rewarding good news.
Matt Hougan begins with a key insight about the current crypto market. The rise of Bitcoin ETFs has fundamentally changed who is buying Bitcoin. Instead of a single type of investor, the market is now driven by three distinct groups: hedge funds running sophisticated trades, attention-driven investors chasing trends, and long-term allocators steadily building positions. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
The thing about Bitcoin ETFs is there are really three investors. There's hedge funds running the basis trade. There are attention investors who go to the spotty, shiny thing. And then there are long-term allocators. I actually think the long-term allocators were accumulating even while we saw inflows. It's just the basis trade disappeared and everyone was chasing gold or AI stocks.
Right.
I think what we're seeing here is the basis trade is coming back again. The attention is focusing maybe again on crypto. So those are not papering over the long-term accumulation. But yeah, I mean, the boomers are why Bitcoin is not down 75%. It would be down much worse if they weren't here. But I do think you'll start to see flows pick up from here. Look, I think AI is going to be great for the economy. I think it's going to catalyze growth. I think the global economy will be bigger as a result of AI. But if you're only in the public markets, you may only feel half of that. You may only feel disruption. If we make an analogy to like the internet, Amazon was public and you could invest in how it was disrupting traditional retail. But imagine it wasn't public and all you could own was Sears and Kohl's, et cetera. You didn't benefit from that upside. That would have been a real loss. So I think the answer is not zero. Most people have zero exposure because it's expensive, it's hard, it's not as liquid, it's not as easy to access. But I think there's a case to be made that the quantity of growth is so large that many people should think about overcoming those hurdles to get some exposure, at least not be on zero. The thing is that 99.9% of investors are at zero.
Right.
This is almost like crypto 5 years ago, pre-ETF. Everyone was at zero, and you were like, "Please, Lord, get to 1." And now it's like get to 5. I think it's the same thing on private markets. Basically, everyone is at zero because it's complex, it's confusing, et cetera. Maybe zero is the wrong number when you have a disruption the size and scale of AI. So is it 5%? That would be a great starting point. I think we're in the bottoming phase. Like maybe the local bottom is in. But could we pull back? Of course we could pull back. But look, I have every confidence that we're going higher, over the next 12 months.
But you don't think 60 or below 60 is in the cards?
It's not my base case, no. Again, I think we could pull back, but there's just too much cumulative positive news. And I would build on something Tom said, actually, to tweak it a little bit. One of my favorite tells of whether we're in a bear market or a bull market is how we react to good news. In a bear market, we ignore good news, right? When Apollo bought Morpho's token, it went up and came right back down. When BlackRock bought Uni's token, came up, went right back down. Today, when we have good news, like Trump posting something positive on crypto, we just rip. So we're rewarding good news. And that is a real change in investor psychology that you don't usually see during during the depths of crypto winter. So again,
for sure.
would it go back down into the 60s? Of course. But do I think we're starting to bottom and trend higher? I absolutely think we do. I think the world is looking to a Warsh rate cut regime.
Yeah.
One thing that I would note, there are all these concerns about jobs and inflation from what's happening in Iran. But if you look out at like what the CME is forecasting for rate cuts in December, they haven't changed over the last month. The dominant paradigm here is AI as a deflationary force, and the administration wants lower rates. And I think it will get lower rates. Maybe that changes if oil like spikes to 150, but that's not the base case that most people are operating in right now. So yeah, not next month, but over time, we're going to get lower rates this year. It's going to be positive for risk assets. In every conflict, the government prints money because conflicts are really expensive, right? In the current limited engagement, I think the forecasts are $200 billion, which is off balance sheet, unexpected spending. It's not like we have a pocket in the Pentagon's budget for a new kinetic war each year, right? That is additional spending. So look, wars lead to money printing, which leads to asset price inflation. It's not the most important thing to think about vis-a-vis a war, but it always happens, and it will happen again here. This is a massive piece of news, right? People have been trying to get narrow banks even before crypto, and then crypto-related banks with access to the Fed's master account for decades, and really intensely in crypto for many years. And that door was just completely shut because the regulators didn't want to. First, they didn't like crypto. Then they were worried about unknown risks. This is a really big moment, big deal, a good thing for the world. I suspect, of course, we're going to see everyone follow suit. It's worth noting there's some limitations to the charter that Kraken got. It's provisional in many ways. It's limited in its use. But it means the door is open a little bit, and I suspect the door will open more. So this is, look, every piece of news tells you that traditional finance and crypto are intersecting. It's in Trump's tweet. It's in this Kraken news. It's in announcements from BlackRock. It's in announcements from Apollo. There's just overwhelming evidence that that's going to happen, and that crypto is going to play a really large role as that intersection occurs. So this is just the latest piece of news showing that. My base case is that they come to the table and they get this completed.
Okay.
Because they're now exposed to like a much worse outcome than they were at the start of this negotiation.
Right.
And so they now have to cover that flank and accept something that at a minimum is where they started is probably the best deal they can get now. And they're now in that defensive position. So I think that will force them to come to the table, but you never know. It's worth monitoring, and I'll be happy when it's actually signed. Banks have spent the last 6 months saying the sky is falling. If we approve stablecoins, our business is over. And now we might approve stablecoins. So that story is going to come home to roost for them. I think that game is over. I think we'll see a non-traditional altcoin season, by which I mean an altcoin season that rewards assets with real-world traction and real-world application. But I don't think we'll see the sort of rising tide lifts all buckets, where you rotate from Bitcoin to ETH to DeFi to NFT pictures of rocks. I don't think we're going to get to that level of craziness. But do I think the market may re-rate like some DeFi tokens, which are trading at billion-dollar valuations now and have huge businesses? I absolutely think that's true. I just think it will be more differentiated than previous altcoin seasons.
While Bitcoin remains the dominant asset in the crypto ecosystem, Hougan expects other sectors of the market to benefit as well. However, the next altcoin cycle may look very different from previous ones. Earlier altcoin booms were characterized by indiscriminate speculation. Capital rotated from Bitcoin into Ethereum, then into DeFi tokens, NFTs, and increasingly obscure projects.
What happened is at 2:30 a.m. on Sunday, as we know, President Trump announced that we were bombing Iran and started major combat operations over there. And the point of the article was 2:30 a.m. is a very odd time in financial markets. The U.S. stock market is closed. The U.S. futures market is closed. Asia is closed. Europe is closed. The only thing that's open are a few small Middle Eastern stock markets. And what we saw was that traders turned to DeFi and specifically to Hyperliquid to trade not just crypto, but to trade oil, to trade gold, to trade other assets. And the point I was making is this opens a massive door. If you're a macro hedge fund, if you're an international trader, and you saw that your peers were able to position immediately in response to the developments in Iran while you were not, you're in trouble, right? So you're going to have to create a stablecoin wallet. You're going to have to fund that wallet. You're going to have to learn how to trade on Hyperliquid. I've seen this before. If you go back to the global financial crisis in 2008, that was the first moment where bond ETFs really shined, because traditional mutual funds couldn't process redemptions because the prices were crazy. But bond ETFs traded just like they were supposed to. They became the focus. And the next year, ETF volumes went up 40%. And the next year, they got above $1 trillion. And today, they're $30 trillion. Sometimes you need this crisis to force people to do a new rail. But once they do it, they don't come back. So I do think it was a big moment for crypto. It's absolutely true that Hyperliquid is not as well established, secure, et cetera, as CME, and people are taking additional risks trading there. And the point I was making is you have to have an extraordinary situation to make you take those risks. But that's what we saw this weekend. And for the hedge fund that's looking to protect its P&L, it's just an easy choice. Would you rather be able to react, or would you rather not be able to react? 100 times out of 100, they will choose being able to react. And I've just heard it from TradFi for too long. People don't want to trade 24/7. You're right, except for when they have to. And this was an example of they had to. And once you open that door a little bit, then you start exploring these things. Then you're through the infrastructure, then you're onboarded. And the thing about exponential growth curves is that you don't really notice them at first. So what did Hyperliquid do on oil volumes? $500 million or something. That's like a drop in the bucket. But the next time when all these hedge funds are on board, they'll do maybe $5 billion in volume. And then the next, that's what we're going to see. So it's not like we're going to wake up and it's all going to be Hyperliquid. It's not going to be CME. It's just, you've started this again. I'll go back to my ETF example and the great global financial crisis. ETFs still aren't as big as mutual funds, but boy, are they hunting them down. And that was the catalyst that put them on that growth path.
For me, ever since, Q4 of last year, I've been operating under a bear market state of mind where I just naturally assume that, especially early in a midterm year, that lower highs will in fact be lower highs and they will not yield higher highs, and that lows will eventually lead to lower lows. So I want to talk about that and kind of go through some of the prior midterm years. In the first midterm year we had after a major rally, you can see that Bitcoin had several lower lows throughout the entire year. And the first one occurred actually in the post-halving year. So you had December of 2013. We then had another lower low here in February of 2014, another lower low in April. And then we continued on, another lower low in September, and then a final low in January of the pre-halving year. So Bitcoin had a series of lower lows, and it also had a series of lower highs as well, where maybe there were times where you would sweep a prior high, but in general, that was what the bear market was characterized by. So I lived through that bear market, and I remember vividly lower highs and lower lows. And in 2018, we had something similar. It was slightly different, but very, very similar in how it played out. We had a series of lower highs, and we also had lower lows as well, but the first drop that Bitcoin had was such a large drop, it took a little while through the bear market to take it out. So we had a high here in December. We had a major lower low in February. We then had a lower low in June, and then the final low in December. But you'll notice we had lower highs throughout the bear market. So it was characterized by lower highs and lower lows, and it ultimately lasted about 1 year. Okay, now go to 2022. You had similar thing, right? You had a series of lower lows and lower highs. So you first had your high in November. You then set a low in November, then a lower high. You had lower lows and lower highs throughout this entire thing. And One of the last major lower lows was in June, another lower high, and then the final lower low was in November. But you can see how it played out, right? So in midterm years, it typically is best to have a bear market state of mind. It's different than every other year of the cycle where you have more like a bull market state of mind, where it's generally characterized by higher lows and higher highs. It can be difficult, of course, to pivot to being in a bear market state of mind when you're just used to watching Bitcoin go up 3 years in a row. But if you're going to pivot to that bear market state of mind, the best time to do so usually is in the fourth quarter of the post-halving year, and then you just kind of stay bearish for like 6 to 12 months, and just assume that every lower low will lead to a lower high, which will then lead to another lower low. Again, will that eventually change? I think so. Yeah, like I don't expect to go on forever, but for now, I am operating under the assumption that we are in a bear market, right? And this is just a series of lower lows and lower highs. And a lot of times you would expect it to take place over a longer period of time, right? You have your first major low in November, you have another one in February. It seems like similar bear markets, right? Starting in 2013, it was December, and then February, and then April. Okay. 2018, it was, you had one way up here in December, and then another one in February, and then the next one was in June. And then in 2022, it went November, January, May, June, November. What I would recommend is try not to get swept up in trying to time every counter trend rally.
Long-term investors are quietly accumulating Bitcoin through ETFs. Artificial intelligence is reshaping economic growth and investment strategy. Monetary policy may shift toward lower rates. Traditional finance and crypto infrastructure are converging at an accelerating pace. And geopolitical events are highlighting the advantages of decentralized, always-open markets.